Hi, everybody. Glad to have you guys here. Welcome to today's webinar. It's being hosted by Surge Energy, which is one of my top picks in our high yield income portfolio. All of the companies in the model portfolio have been chosen because I believe they are trading below fair value, have sustainable dividends and growth potential. But for that portfolio, the number one criteria is they are generating enough free cash flow to sustain their dividends. With growth being the second requirement I'm looking for. I should really rename it the growth and income portfolio, or income and growth portfolio. My current valuation of Surge's common stock is more than double where it closed yesterday, which was at $5.88 Canadian. My valuation is like $13 Canadian. As Harry Van Neck and I discussed on last week's seminar, all of the Canadian upstream companies are trading at a discount to their U.S. peers. We believe the reason is the fear that Trump will soon put tariffs on imports of oil and gas from Canada. I personally do not believe that he will do that because it would significantly increase U.S. gasoline and diesel prices, the reverse of what he promised to do with the baby drill program. But anyway, joining me today are Paul Colburn, President and CEO, and Murray Bai, Chief Operating Officer for Surge Energy. Paul is the company's President and CEO. He has 25 years of experience in the oil and gas industry and has held executive or director level positions with over 30 oil and gas and energy services companies. He has successfully grown and subsequently transitioned a number of aggressive Canadian junior oil and gas companies into sustainable, modest growth, dividend paying companies with excellent results, including StarTech Energy, Crescent Point Energy Trust, and Star Point Energy Trust. Murray Bai has been with the company since it was started in 2010. He is the company's Chief Operating Officer. Murray is a professional engineer with more than 24 years of engineering experience, including development, production, and reservoir management in Western Canada. He has been on the Surge executive team since 2013, and prior to that, he was the asset team lead when he joined the company when it started in 2010. He graduated in 2000 from Montana Tech with a petroleum engineering degree. After graduating, he held several positions with Encana Corporation, which is now Vintiv, which is in our Sweet 16 growth portfolio, between the years 2000 and 2010, including group lead of development, exploitation engineer, and production engineering. Before I turn it over to Paul, I want to point out that Surge Energy's revenues are heavily weighted to oil sales. In fact, they recently sold some non-core assets that were more weighted to natural gas. It pays monthly dividends, and it has a significant amount of high-quality drilling inventory, which I like to call running room. So during the webinar, if you have questions, please type them into the chat box, and I will answer them, or we will answer them after the presentation. With that, I will now turn it over to Paul Colburn and Murray for an update on Surge Energy. So take it away, Paul.
Thanks very much for your time today. We love doing these. They're a good way for us to get our story out. The gloves are off for me. Dan, the gloves are off. Our goal is to be the #1 performing public oil company in Canada this year in total rate of return, meaning stock price plus dividend. And I think we're going to be. And Surge was the top performer in 2022 when crude ripped to $125 on the Russian invasion. We were not the top performer in 2023. That was Athabasca, and last year was Tamarack. The oil guys in Canada have been taking it on the chin a bit. The gas guys seem to have this love fest from the market. We're 91% light and medium gravity crude, and we'll show you a slide a bit later. We're putting out these incredible quarters. Our Q2 was ridiculously good. Q3 was really good, not quite as good, but oil dropped $5 a barrel in Q3, but we put out a hell of a quarter. Here it is here. But our Q4 is a blowout quarter. We're going to cash flow more in Q4. Even though oil averaged 75 WTI in Q3, we're going to have more cash flow in Q4 when WTI averaged 70 WTI. And we'll show you, it's a big production beat, cash flow beat in Q4, and it's already looking amazing in Q1. And what's driving it is our asset quality. So it lets us put out these quarters, beat the street on production, beat the street on cash flow, did a beautiful term debt deal, termed out all our long-term debt, 175 million deal, 5 years, attractive price, covenant light, a $250 million undrawn bank line revolver, $250 million. Beautiful dividend. We have an 8.5% yield and a really low payout ratio. As Dan mentioned, our payout ratio is only 17.8% of our cash flow. It's the third lowest in Canada. And to show the bargains that are on sale in Canada, we still got over an 8% yield with a super low payout ratio. One thing we've started to do is our normal course issuer bid. We're trading just over our PDP value in the company, and we have 900 drilling locations in our company, and we drill about 65, 70 wells a year. So a 10-year inventory. So we're trading at our PDP value, which is blow down the company value, is our stock price today. So we're in buying the heck of our stock. Murray's going to walk you through a big new discovery, the biggest in our company's history. We announced a couple quarters ago at Hope Valley, 100 drilling locations. We've drilled 8 screamers in a row. We've delineated it. It's like a 20-mile long field that he'll show you. What drives these great quarters that Surge is putting out? And there's not many good oil companies left in our space in Canada. There's Surge, there's Tamarack, Headwater, and maybe Cardinal. That's it, of the good intermediate, small intermediates, large juniors. Well, why are we starting to outperform our peer group? Asset quality. Asset quality always drives top financial results. We have it. Huge oil in place, reservoirs, shallow conventional reservoirs, highest operating costs, top decile operating netbacks, low recovery factors. So we'll show you that. And what it turns out at the end of the day is free cash flow. There's a slide coming up here. We'll show you that Surge has one of the best free cash flow yields in Canada. These are our numbers for the year at 70 WTI. Oil's right around, just dropped right around 75 WTI right now. So you can see our numbers here. We're going to cash flow 275 million, free cash flow 85 million. Our dividend is 52 million. So 31% free cash flow margin on every barrel we produce. Our debt, one of the best balance sheets, not 1.8 times, 0.8 times debt to cash flow, because that's what the market requires. We have a lot of tax pools, meaning we don't pay Justin Trudeau taxes. 1.3 billion of pools, about a 4-year tax horizon. And we're covered by 10 of the top analysts in Canada. Here's our numbers. As I mentioned, we have excess free cash. So we've hit our terminal debt targets. We're really starting to ramp up our share buyback program. We've got the dividend. So we're aggressively buying stock back and even paying debt down further. We do have a $250 million undrawn bank line. There's our term debt. We have a little convert that's still got about 3.5 years of tenure on it. And there's the undrawn bank line. Now, this is put out just a few days ago. The #1 biggest energy mutual fund in Canada is 9 Point, Eric Nuttall. He says Surge has the best free cash flow yield of any oil company in our peer group in Canada. And it's just about 20%, 19-20%. So that means we're one of the best bargains in the country. Dan said it a different way, but we're saying there's a great way of measuring. You're getting a 19% return owning your Surge at current oil prices. The macros are irrefutable. It's getting silly, the lies that have been told and whatever. I don't know what it was, Dan, when you started in the business. When I started in the business, the world needed about 70 million barrels a day of crude. Last month, the world needed 103.7 million barrels in August. And now Standard Chartered Bank says we're going to average 103, almost 104 million barrels. 6 billion out of 8 billion people in the world today are all industrializing at the same time. And you got 2 wars going on. So you got world record demand hitting all-time highs every month. 6 billion out of 8 billion people, China, India, Asia, and Africa, all industrializing at the same time. They need every barrel, and 2 wars going on, one in the Middle East. I kind of like the macro for oil. This is my favorite slide. It's an unbelievable slide. So for investors on this call, high net worth, family offices, retail investors, and even institutional or small institutional. Pop quiz for you. And for you, Dan, what's the greatest investing model of all time? Unless you're smart enough to just walk out and buy and figure out what the next NVIDIA is or whatever, AI stock, it's the increasing compounding dividend model. I didn't say it. Ned Davis Research, top firm in the world at these things. So if you invest $100 in common equities in 1973 with no dividend, let's say Dan does that, and I put mine in common equities in 1973, $100 with a dividend, an increasing compounding dividend. At the end of today, or like 50 years later, Dan's got $843 on his 100. It's okay, but it's not great. Paul's got, because I put mine with an increasing compounding dividend company or group of companies, mine's worth $14,118. That's Surge's model. And if you look at it, we bumped the dividend 14% 2 years ago, 8% last year, and we're already got massive free cash flow this year. So we're just letting you know that that is our model. I'll do this slide. Murray's going to show you the whole. I mentioned to you, I bragged about our asset quality, so I better be able to back it up. Big oil in place, low recovery factor, low cost conventional reservoirs, wildly outperform deep expensive plays like the Montney, the Permian, and the Duvernay. So 0.1 mil at RC and tighter rock on the bottom of the chart to the left. Deep expensive tight rock, tombstone basically, tight rock that costs huge drilling costs, huge fracs, huge declines that don't water flood. I don't want those. That's not good for a dividending model. So Surge, we're 0.1 mil at RC. Over on the right, our new Sparky discovery is 500 mil at RC rock. It's off the chart by a factor of 4 to the right, this new Sparky discovery. Low cost, low risk, shallow conventional reservoirs that water flood. Look above the line, the PIR. How many times do you get your money back on a stock, on a well? Look at the IRRs. They go through the roof. That's Surge. And that's why I say asset quality drives top financial results. It always should, right?
Thanks, Paul. So we'll get into that a little bit, our asset quality here. On this slide, we're going to show you guys our 2.3 million or billion barrels under management of oil in place. It starts there. We chase the high oil in place per section and 10 to 5 million barrels per section. We have over 860 locations identified with only 393 of those booked in our reserves. We've got high working interest, low cum to date at 8.9% recovery factor, and we're booked at 12.2. So, we see the power of the conventional assets is getting these primary, from 10% on primary recovery factor to 20, 30% on water flood. Over 55% of our current production is pressure supported on either water flood and or bottom water drive. So that's the power of these conventional assets is you also get those EOR barrels. A 1% change in recovery factor is huge on those, 2.3 billion barrels. You get another 23 million barrels every 1%. And our total PDP produced reserves are around 38 million barrels. So you're almost getting half of your, total current production barrels on reserves for every 1% change in recovery factor. So that's why we love the conventional asset space. We'll get into our core areas, the Southeast Sask and Sparky. It's, after our disposition in Valhalla, we sold, 1,500 BOE of mainly gas barrels, low net back for us. So now we're, 90% in our two core areas, 95% of our capital, and 95% of our cash flow. And that's why we're focused, we'll show you why we're focused on those two areas. So this is our chart that we're, really love to get out here in January. So Peters & Co does had a great conference last week up in Calgary, and they put out this data. So it's third-party research by Peters & Co. So on the left is all the plays in North America on half-cycle payouts. The blue bar is the 1 times payout on drilling, and then the 2 times payout is the gray bar. So what we love about the power of the conventional plays that we have, and you can see them there, we're the top 3 plays of 4 in North America, this is including the US, is we're getting our second payout at 2.5 years. You can see as you go down, you know, compared to some of the US ones, Permian, Delaware, the Midland Basins, DJ Basin, your second payouts are 10 plus years. So the power of the conventional assets, we're drilling these wells from $1.5 to $2.5 million. We're getting our money back in less than a year, and we're getting our second times payout 2.5 years. And then we're actually water flooding most of these and getting a third, fourth, fifth payout. So the power of the conventional assets is the low cost of drilling and just these phenomenal economics.
So one thing I was going to mention on this exact point, and Dan, we talked about it last time we came down to see you down in Texas, is sometimes investors feel kind of taken advantage of, or they don't understand all the lingo and that. Well, this dummies it down for people like me, because I'm just a lawyer. I don't need to be an engineer or geologist to know I get my money back on certain plays in less than a year and 100% profit in just over 2 years. So I get my money back and 100% profit. Well, and investors start to realize, oh, all these great plays, like in Canada, we've got the Montney, we got the Duvernay. Well, this chart, these are the best plays. There's 90 of them. We truncated because you can't put them all on one page. But it just shows, you might think, oh, this company did a great acquisition in the Eagle Ford. And, you know, the wells pay out in just under 2 years. But the second payout is off the charts to the right. It's over 10 years. So you don't make any money. You don't get your second 100% profit for 10 years. And this is key, is look at now, and as the government changes, we'll probably talk about it in the question and answer, as the government changes here to a right-wing, more normal, conventional, conservative government, and we have a corrupt, inept government today that we're living. The exciting thing is you watch money flow back into Canada, because 1, 2, 3, 4, 5, 6, 7. The 7 top plays in North America are all in Canada. Then I got the Permian, Delaware, and some of the other ones kick in. So we think investors to be picking the Surge, the Whitecaps, the Tamarack, some of the companies in Canada have these plays. And then we see foreign investment switch in the elections in just, it has to be by November and probably going to be before.
Right.
Yeah,
So
Paul,
this is empirically just showing. Yeah, go ahead. Sorry, Dan.
Yeah, I was going to say, in the good old days when I was, in the 90s, 80s and 90s, when I was in oil and gas industry, if we had wells pay out in 3 years, we thought it was great.
Yeah, right. It is great, actually, if they pay out first time in 3 years. It is good. It's the second payout, this chart.
And this is what feeds the dividend model, right? Because you're on you're on full money. You need the free cash. These wells, we're getting free cash out of these wells in less than a year, and then a full profit, 100% profit after 2. So it's amazing. So we talk about, okay, we have top asset quality. Like this is a chart empirically shows, and you just keep drilling these wells and backfilling our model for the free cash.
So over 100 or over 90%, 91% of our companies in these elite plays, and 100% of our capital is going into these plays. And that's why we're putting out these great quarters.
So I'll jump. So the Sparky play that we have here in Canada is 11 billion barrel trend. So it's one of the largest oil accumulations in Canada. It's been on production since it first produced in 1922. It's produced 1.3 billion barrels. So it's a huge asset. What we did early on 10 years ago is come into this lighter gravity window. So to the Lloydminster, to the northeast, it gets heavier and shallower. And we were able to come up with a signature on horizontal multi-frac at that time. We were doing small fracs. So part of the cost here is just really small fracs, 10 tons per stage, low cost wells. And really people thought some of this might've been wet. So really back then it's like people thought it might've been wet, and we've been getting consistently 50-60% oil cuts throughout the play. We've now gone into, we'll talk about the multi-lat drilling technology. We're now going slightly heavier, 19 API, 300 centipoise, slightly heavier. And we'll show you how those wells are doing as well. But yeah, we have great, we've drilled over, 250 wells in here now over 10 years. So we have a great track record. We were an early, adapter to this place. So we've got a big dominant land position. We own over 1 billion barrels of oil in place on this, in this light medium window is about 3 billion barrels, and we own 1 billion of it.
So Dan, when I first met you several years ago, we're doing about 4,500, 5,000 barrels. Now we're doing 12,000 barrels a day. It's turned out the Manville stack, the Clearwater in the north is in the Manville group of horizons, and then our Sparky. It's now the hottest play, oil play, conventional in all of Canada, maybe North America, supplanting the Permian.
Yeah, so this is our growth chart since the very beginning. You know, now we're up to 12,000 barrels a day from just under 2,000. You know, we have the 1 billion barrels of oil in place, 520 locations, 140 of those are multi-lat. So we have a great 12-year drilling inventory runway. As you said, we're only drilling 38 wells a year right now of these great wells to kind of hold flat to 5% growth. Here's the Provost Cadogan area, just as an example, and this is our single leg fracked part of the play. I'll just go quickly through here, but what we love is on the right is every second well, we're also water flooding. And that's another thing is those economics we were showing were primary only. And we're actually getting these up to, you know, a well here, if you look at our type curve, is 120,000 barrels per well, 1,400 meters, so a mile long well, 26 fracks, but we're doing those for, you know, $1.6 million. What's interesting on the water flood basis is we're tripling, quadrupling those reserves. We're getting total oil bank conventional water flood here, and we're getting the offsets to 300,000-400,000 barrels on water flood. So this play is working phenomenal. We're doing the small fracs, 200-meter spacing, and getting the water flood barrels as well. But you can see these wells are 112% rate of return, 1 year payout, kind of like that 3-year pay, 3 years to get the second payout. This area here alone, we've more than doubled through drilling and organically. So what I want to spend a bunch of time on is just our new discovery that Paul mentioned at Hope Valley. We have over 200 million barrels in place, 5 to 8 million barrels per section. We've amassed 32 sections. You know, we have 80 to 100 locations defined right now. We've drilled 8 wells since 2024. And I don't know how everybody on the call, but in the last 5 years, the multilateral technology has really taken off in Canada. It started in the Clearwater, slightly heavier oil, and we've adapted that technology. So what we're doing is drilling 12 laterals per well, mile long. So you're drilling one well with 12 miles of reservoir contact. Each leg is about 25 to 30 meters apart. So I guess in 25 yards apart, walk 25 big steps. And we're essentially mining these oil in place per section and getting great results. So for this economics here, you're drilling these wells for $2.5 million. We're drilling them in 20 days. So each lateral is only taking a day to drill. We're getting the drill times really down, getting those costs to $2 to $2.5 million. You're getting EORs of 175,000 per well, IP90s of 170. So we're getting these MPVs around $5 million per well for a 2.5 million investment. That's discounted. We're getting 180% rate of return in those 0.8 payouts. So that's that second best play in North America kind of economics. And you can see our first 8 wells, we're beating this type curve. Every single well is like 250 barrels a day.
So the type curve Murray described that's written there on that page, we now have 8 screamers in a row drilled that are IP90s right around like 225 barrels a day. The first one you can see there is public data, 236 barrels IP90. So we're doing about 25% better than this type curve. And we drilled 8 of them in a row. And the big one was to the northwest there. We stepped out 7 miles. So we've drilled 6 screamers in a row, built a beautiful new battery. We see all this excitement. We just completed those wells. One's at 248 barrels a day, one's at 235 barrels a day, tons of fluid, still cleaning up, and there are only 8 leggers. So we're thrilled about this. Is the biggest discovery in our history, and until our engineering comes out in a few weeks, it's not booked in our engineering yet.
Yeah,
this
Paul,
thing is not booked.
Yeah, so the laterals are not cased.
Correct? Right, so that's what's interesting.
Open hole, yeah.
So you drill your intermediate, case it, and then we drill 12 laterals, all open hole. And there's no liner. And what's beauty about our window there, when I showed that first map, we're just slightly heavy here, like 300 centipoise and about 800 meters deep. So we have great competent rock. We haven't had any wellbore collapse. And that's been kind of what's really kicked off this play. Is in 10 years ago, everybody thought we needed liner and we had rock consolidation issues. on sand production, but we've in our window, we have seen zero sand production, zero wellbore collapse issues, and it's just phenomenal results. So we're kind of drilling these 5 wells a section to get the full section. And we're looking at water flood as potential, leaving some gaps for injectors. But right now we're chasing this on a primary basis. We also, last year, were proud to build a battery. You can see the outlines here. We've now shot a subsequent 3D seismic, and we're going to be testing that to the south. So we just see this as a great asset going 3, 4, 5,000 barrels a day. And the beauty of conventional is we got in early, got the land cheap. We built the battery for $5 million. $4.5 million, and the 3D seismic we invested, $5 million, and we're off to the races and adding production like this for that kind of tree.
Let me ask you this: in your forecast guides, your production guides for 2025, are you using the production in the type curve?
Yeah, so good catch.
So you have upside.
We're using that type curve, and so far the wells have been exceeding, and that's part of how we're looking good here in Q1. Right now at Surge Energy, we have 3 rigs load leveled for the year pretty much. And one of those rigs is just multi-lats drilling. So we've really upped, we've got about 20 wells under our belt, 8 in this area. And now we're just going to load level a rig here all year, about 14 drills.
So Dan, you figured out our surprise. You figured out my surprise for the market. Why we're putting out better.
Yeah, we're beating our type curve right now.
We're beating the type curve. You figured it out. You bugger.
Yeah. We're beating the type curve right now, 30%. The other thing with the power of the conventional assets is this chart's only 60 days, but our first well is still over 120 barrels a day over about a year out now. So like really good low decline wells, and they're just hanging in there.
Well, are the engineers for your third party engineering report? Are they giving you credit for this better production, or when do you?
Yeah, we're getting. So Paul, we didn't really book much last year. This year we're going to book a little bit. Maybe 15 PUDs out of the 80, and we're getting good recognition around that 150 to that 175 kind of barrels on type curve. So yeah, we're getting great F&Ds, and we're getting recognition for those wells. Our auditors like these rates and the decline profiles, so they're matching us really close.
Yeah, good. And then, okay, on the gray boxes on there, those squares, are they held by vertical wells?
Yeah, so the gray is actually land we don't own.
Right.
A lot of this is checkerboard freehold with a few big companies in Canada that we're continuously working on to try to get a bit more land. A lot of this we got on Crown and some freehold. But yeah, the cost of entry here is what I love is like you amass all the land for $5 million, you build a battery for $4.5 million, and you shoot $5 million at 3D. So for $15 million, our cost of entry, and now we're drilling 250 barrel a day wells and going to get it to 5,000 barrels.
Yeah, and this is all like API 20.
Yeah, 19 to 20 API. Yeah, and on diffs, it's we get a slight premium to WCS, and with our TMX line here in Canada, our differentials have really tightened, minus the tariff chatter. We're right around that $12 to $14 diff. That's the one thing we see on tariffs is the diffs have moved out $3-4. That's how we kind of see how it hit Canadian companies is our differential would come out a little. So, but no, diffs are about the tightest they've ever been around that.
Yeah, I can't wait till they just. First of all, we need this heavy oil. That's what everybody on the call needs.
The refineries need our Canadian. We have 4 million barrels every day.
Yeah, we import over 4 million barrels a day of Canadian oil. It's heavy oil. We need black oil. I call it black oil. We need black oil to make diesel. You can't make diesel out of this ultralight oil that's coming out of the Permian. So we're exporting. He wants you to drill. Let's say if we drill baby in the Permian, we'll just export more oil because our refineries can't handle it.
Right.
Yeah, and part of what's interesting is we will look to a potential 5% growth, 3 to 5% growth at $80 oil, but it's kind of back to your point. We just like the free cash versus drill baby. I don't mind the slight growth, which we have the inventory to do, but we love the free cash, and we're just I don't know if we're as a Canadian company anyways, we're not super motivated to go high growth and hurt your sustainability and hurt your decline and all those things. We like the keeping our decline down and a free cash model.
Yeah. Okay, I'm sorry, I won't interrupt you.
Yeah, no, it's all good. So then the other core play is our light oil play. It's basically Cromer, which is WTI equivalent, straight up light oil. We're having phenomenal success in the Frobisher, and we also have these Ratcliffe Midale water floods that help our decline here. So we have that, you know, the balance of the great primary drilling and also the water flood. And this is some of the highest netback in Canada with those light oil right in Southeast Saskatchewan at $47-50 netbacks at 70 WTI. So phenomenal cash flow here. So what are we excited about here? We showed this is the second best play in all of North America. Well, these wells, we've drilled 69 wells in the Frobisher, and we're getting 180 barrel a day IP90s. This is all third-party data, all public data on our wells at 180 barrel a day for like $1.5 million drills. So just phenomenal economics and results for our peers. So we're top Frobisher driller in the basin. We have 400 million barrels of oil in place, 250 locations, a great 8-year inventory. And the guys are doing an awesome job of just continuing to add crown and land to that. We're full court press to just keep adding some Frobisher lokes. We're 9,000 barrels a day and continued success. I'll show you this here, how, you know, what's kind of interesting is how we're really doing this is a multi-leg laterals as well, just in the vertical sense. So we're trying to show in the top log there, well log there, in the early days here in the 50s and 60s, they would drill one lateral or one vertical and a short little horizontal. We're now drilling 3 laterals, multi-leg vertical sense there and getting these results. So our type curves on the left, 1.25 million, getting 80,000 barrels, 180 those IP90s. We're getting 330% rate of return, payouts in like a half a year. Second payouts 1.5 years. And you can just see our chart here in Steelman. We've been drilling, the top driller in all of Saskatchewan. We had a well at 450 barrel a day IP90. We've got 225. We had 230, 348. So we're crushing some of those type curves as well. Like some of these wells are paying out in 2 months. So we have great run room here. Like we have a good 3-4 year run room. When we acquired this. And then what we're trying to show with the green and the yellow there is we had an acquisition here coming out of COVID, right balancing, you know, and then we've done a lot of organic ads in the yellow. So it's our MO of some great A&D and then some great organic ads. So, you know, we've more than doubled this property, phenomenal. So that's what we're drilling. We're kind of our whole Q1 programs in here is all Steelman, all 3-leg wells. And we're seeing you know, similar results. We have a well, this is the 3rd day on cleaning up over 300 barrels a day right now.
So we'll leave you with this last slide, guys, and then open it up for questions. I want to be the top performer in the country, and you're not every year. We were in 2022, Athabasca was in 2023, Tamarack last year, and we're 3 times EV to DACF. That means we're trading at 3 times our cash flow divided by our shares. Some of our peers have moved up to 5, 4.5. We're at 3. Some of our peers are at 2 times that don't maybe have the asset quality, and some are at 1.5 times that don't have the asset quality. So I love our stock price because this is where you can make money on a stock. So we have 2 of the best plays in North America on well payouts and second well payouts, meaning where the most profitable wells in North America. A big new discovery that's not even booked in our prior engineering report. It'll be lightly booked this year. We're only going to book about 18 locations out of 80 to 100 we have. We have one of the best balance sheets. Debt is 0.8 times, not 1.8. It's 0.8 times debt to cash flow. And a dividend that's 8.5%, but it's only a 17.8% dividend payout ratio of the cash flow. Like super low, 3rd lowest payout ratio in our peer group. So we're thrilled about it. It's exciting. And I love the feel of, think of us as the Detroit Lions before that last playoff game. We're excited. We think we're going to the Super Bowl. And never every year, we did in 2022 and oil went to 120, we're the top performer. But you always want to be in the hunt and the mix. And there's honestly not that many good oil companies in Canada. I ticked them off where there's Surge, there's maybe Tamarack, Cardinal, and Headwater. In this, this is where you can make the money. CNRL's near its all-time high, brilliant company. I love Love CNRL, Suncor. Well, these guys are at 6 and 7 and 8 times EV to DACF. Surge is 3. So the real money to be made is guys like Dan analyzing and stock picking the companies that have the best assets, a great balance sheet, a great dividend, a low payout ratio. And when you look at us, I didn't say it, Eric Nuttall, there's 10 of the top analysts in Canada. All 10 have Surge as a top pick or their firm's top pick for oil. So it isn't just Paul waving his arms or Murray or Dan. There's 10 of the top analysts, and check the target price out, 1070, and we're trading in the fives today. And I love it because I am one of the biggest shareholders. I love the dividend, and I'm going to be buying more stock here. So that's our story. We'd open it up for any questions people might have. Over to you, Dan.
Yeah, I just want to mention everybody. So I do have a detailed forecast model for this. Well, I compared my model to, I think, 6 of the ones on this list, and I'm very close on, you know, production and everything, because based on your guidance, and I'm coming up with this huge operating cash flow, free cash flow. I'm higher because I'm using a higher oil price. I'm assuming WTI is going to average 77.50 this year. I do think once we get past the fear of drill baby drill, and let me tell you, when stocks move based on fear, and I think this fear of tariffs or whatever. First of all, I think even if he does put if Trump puts tariffs on Canada, it might exclude oil and gas because we need oil and gas so much.
Right.
But even if he does, you know, Paul, he's not asking for much. You know, he asked Trudeau, you need to shut down the border. We don't want illegals coming across the border, and you need to shut down the drug traffic. Well, I don't think that would be too hard for Canada to agree to do.
Exactly.
So if they agree to do it, there's probably problem over, and you can focus on Mexico. But you know, and I'm coming up with $13. So there's only 1 or 2 above me. The 13.75 and the 14 are above me. And I looked real hard at that. Carmark Securities one is very, very close to everything in my forecast. So forecast model. So let me get into some questions now. I don't know if you guys are aware, but in the last year, a guy named Harry Van Eck has joined EPG, and he's really, really helping me out because he's covering like 80 companies, and he's reviewing all my models real carefully. And he's like I am, 70 years old. We got, you know, 40, 45 years experience in the industry. And, you know, we can look at these companies and evaluate them pretty quickly because both of us worked in M&A. And he was the top petroleum economist for Shell. He's based in the Netherlands. But anyway, very helpful guy. And I'll send you a link to our last webinar we did jointly. Interesting guy to hear. But he went through it and was saying when he looks at his models, all the Canadian companies are trading like at a discount to their peers in U.S. If you compare, you know, mid caps in the U.S. and mid cap in Canada, the ones in Canada are trading very much lower price based on their fundamentals. So anyway, okay. So Harry sent me some questions this morning. So I'll start with his, and then we'll get the ones in the chat box. His first question is: there was a 5% production drop between 24.0 thousand BOE per day and 22.5. Is that a once-off thing? And will growth resume in 2016, or is you can explain it? Was the sale of those non-core assets, right?
Yeah, we sold Shaman, Westeros, and then Valhalla at the end of the year. Non-core is about, you know, that production volume, but it was only like 2 to 3% of our cash flow.
Mm-hmm.
So on a, like, for example, when we sold Valhalla, we didn't change our cash flow. The production's down, but the cash flow, like we were getting rid of non-core, non-cash flow assets. So the headline prod number is down, but the cash flow is not.
Are you, a side question on that, are you starting to see some impact on the natural gas prices starting to move up?
In Canada, it's we're still getting AECO pricing is still getting pretty huge differential to NYMEX and Henry Hub. So yeah, Canadian gas prices aren't great, and that's part of that Valhalla asset. It was half gas, and it just didn't have the net back there. It was 1,500 BOE, but you know, $3-5 net backs.
Yeah, but it should move up. I mean, right now we got this surge in LNG exports. You know, we're exporting like 5 BCF a day more this first quarter than we did last quarter because one of the big LNG facilities was in Freeport was offline for the entire winter, really. And so now we're up to like 7. I think we have, when all these things are totally ramped up, we'll be exporting over 17 BCF a day with the goal under, you know, Trump is super bullish on wanting to increase our exports because we've got a big trade deficit, and we're on track to get to like 35 BCF a day of exports, and then you're going to see global prices for our gas. I think you'll get up to like maybe 1/10 the oil price or something. Anyway, okay, does Surge, do you have a 5-year plan strategy of where you think you'll be in 2029 production wise?
Yeah, we have a 5-year plan. Murray and our corporate development team put it together. Just for the question prior, which goes to the 5-year plan, Dan uncovered my secret sauce. I have a reputation for the last 30 years for the top companies, put out numbers and go beat them. So our latest production week was over 23,000 barrels a day. Well, we sold probably, I don't know if you add the two up, we probably sold almost 3,000 barrels. We're 25, so we should be 22, and we're 23.1 yesterday's production number for last week. And we have 20 more wells to bring on in Q1. So we're already replacing the non-core sales, and these are the two of the best plays in all of North America. So it's very cash flow accretive to the non-core sale barrels. So our 5-year plan has us at 70 oil, staying flat. If we get 75, we'll have a small growth wedge, and at anything over 80, we're looking at a 5% production per share growth wedge and move those 860 locations. We only book 383, so we could easily add an extra rig in one of our core areas or both, and add that growth wedge. It would be about 25 to 30 million and add a growth wedge. Right now, we'd rather buy the stock back because we're trading, frankly, Dan, given the Canadian peso and Justin Trudeau discount, we're trading at lower, you just said it, lower than our peers. So we'd rather buy our stock back.
Yeah, right now we can get 5% production per share growth on the buyback for $30 million of buying the stock.
Let me ask you, do you sell your oil in WTI and then it converts to Canadian, or do you sell it in Canadian?
Exactly. It's all tied to WTI.
So we're getting
so
100
so the fact that the
right
Canadian
now,
dollar is down
100.
helps you, right?
Yeah, so the Canadian dollar has been phenomenally good. So for every cent of the dollar drops, it's $6 million of incremental cash flow. We budgeted at 72.5-cent dollar, and it's 69. And then for every dollar of WTI, our cash flow is $8 million increase. So every cent of dollar is almost equal to every dollar of oil, if you think of it that way for Surge. So the dollar's really been buffering us right now, and that's back to the tariffs. If the tariffs come in, then our dollar gets cratered. But we're actually able to hedge the dollar and oil at 75 and the dollar at 69 and get above $100. Our receive price is over 100 a barrel Canadian.
So for people on the call, what Dan just said, Surge is getting about $105 Canadian a barrel for our oil. And trust me, we look good at 90 or 95, but at 105, we are churning out free cash.
Yeah, I am using, let's see, for my oil price, my forecast for the fourth quarter, I've got like $84 Canadian. But you're saying but that includes your hedges, the impact.
Yeah, and then your diffs, you got to take the diffs into account too.
Yeah, and they take a differential too. Okay.
Yeah, so when we're talking 100, that's straight WTI, and then we have a $14 US differential on WCS.
Yeah.
So you get down to that 85 Canadian probably received, really close to that. But like that's where your point is. We're getting 85 received after all diffs, and your OPEX is 18, 19. So in your royalties, so you're getting these netbacks of 40 plus.
Yeah. Are your NGL prices improving?
We're seeing a little bit of that, but we're very minor. Like we're about $1 million of, like our NGL and gas is about like 2% of our revenue.
Yeah, I know. I'm just
like we're just so tied to oil. I don't. Yeah. We're just so tied to oil. I don't focus a lot on that.
Yeah, I agree. Well, where did I just lose my stuff? Okay. All right. Another question. 5-year plan. Okay. Harry asked that your CapEx dropped from 182, or went from 182 in 2023, 190 million in 2024, and now your guidance is 170 for today. And I think you answered this question. If the oil price in 2025 moves higher, like to $80 by the third quarter, will Surge increase CapEx and, you know, drill and complete more wells in the second?
Yeah, like right now we have nine holes on our rig schedule to keep fully load leveled for multi-lats. And that'll be a decision in June, depending on price. But what I want to highlight is we didn't say is with our asset quality continuing to outperform and drilling better wells, we were able to drop our capital 20 million to drill the same amount of wells. So we've also coming into the year, that 20 million capital drop is drilling similar amount of wells, and we're just drilling better PE, better quality wells again. So it's a testament to our asset quality to be able to hold our production and have slight growth with less capital.
Yeah. So your maintenance capital, it would be like this 170, 180, you can maintain flat, but then you got years and years of drilling
Correct.
inventory.
Absolutely.
Right.
And then if the wells produces above the type curve, that's just gravy on that.
Correct.
I will tell you that in our small cap portfolio, and you guys are in the high yield income portfolio, it's like half the companies are trading below book value.
Right.
Based on what I heard here, you're definitely a screaming buy at your current stock price, because they'd be getting the company.
We're trading at close to PDP. Like we're working on our year-end reserves. I don't have it final yet, but we're in the realm of close to PDP production, which is our blowdown case.
Yeah,
That's like we shut down the company, send everybody home, and just go on blowdown, and that's close. Like trading on PDP.
Yeah, and that's even crazy, because you wouldn't just give away the other acreage; you'd sell that.
Right.
Right.
Yeah.
Even
So
if you decided today, tomorrow, you're all going to just sell off the company, you wouldn't do it that way.
Yeah.
Anyway, let's say okay. Is there enough? Is facilities as pipeline? Is that getting your wells completed to sales and everything in Hope Valley? Is there any problem there?
No. So right now we're working. Yeah. Right now we're working on some potential LAC connections. But in the interim, we're able to. We're right now. This battery is trucked sales oil. So, but that's the beauty of these conventionals, like versus say the gassier plays where you need a gas plant, takeaway, all these things. We're able to just truck our oil and get these batteries built cheap, and in a quick time period. So there's no real.
Do you have to reinject the gas there? Do you sell the gas, or is there any gas?
Good question. We're flaring slightly, but it's minimal gas, and these have like this medium crude. So we are tying in the gas in February.
Okay, good.
So we really don't flare much gas throughout all our assets.
Okay, let me get to the questions here in the chat box, see what anybody's asking. I don't want to skip them. Have you considered selling your non-core asset? Is it Slave Point?
Yeah. So if I go, we did try to do that last year. We didn't get a number that met our criteria. So this is now getting to be like 2,000 of our company, and we're not spending any money there. So yeah, that thing's always for sale. So we'll just see what happens this year if someone hits our take price. Last year we tried to sell it last year, no one hit her. We never had enough, didn't get our take price, so we just kept it.
Yeah, and the next question says, will you see the banking sector return to the oil patch? But you don't have, I mean, you already have a line of credit, right? That's even undrawn, 250.
Right.
Yeah, so we have a syndicate of banks, National Bank, Bank of Montreal, Alberta Treasury Branch, and the BDC Bank. It's undrawn. CIBC wants back in. We're meeting with them next week. So the good part is we have a $250 million line that is completely undrawn. Now it's available for little tuck-in acquisitions or buying the shares back or anything we want. But we termed out our debt September last year with really attractive terms. 175 million, took out all the bank debt, covenant light, good terms, 5-year term, and yeah, we're thrilled about our balance sheet. It's one of the best in the sector.
Yeah, it was amazing for us to get term debt at our size and for the term debt markets to open coming down cap. So that was like an awesome, amazing transaction for us to get that kind of debt versus always just being on our bank line.
Yeah, one of the better things that's really happened to the upstream, subsector is that pretty much all the companies are really focused on strengthening their balance sheets. They don't need to go to the banks anymore for growth, or they don't need to go to the capital markets to sell their stock at ridiculously low prices to grow.
We're buying our stock back, to your point.
So with our free cash profile, to your point, we now have like at year end, we have cash on balance sheet.
So can you flip back to our numbers? I got a little slide for, or thing, yeah, this one. So we didn't luck out. A week ago, crude went over 80 WTI, and today,
All
as
right.
I walked in here, it was 74.90 or something. We hedged. We had 7,000. Dan, your number is not crazy. We had 7,000 barrels in Q1. The last one we got off was 5,000 barrels at 77.50 a barrel. But we're all in, we're about 75, 65 WTI on 7,000 barrels a day in Q1. We did 5,000 barrels in Q2. We did 4,000 barrels in Q3. It's a backwardated curve, but locked in prices way above these budgeted numbers. We haven't told the market yet. It's not material, but it's exciting for you guys to know. Surge is locked in values way above this chart for 2025, and we'll be putting that in our Q1. And it's thrilling because that
in the dividend model, in the dividend model, when oil is above our budget, if every time oil hits 80 spot, we're really looking at the short-term swaps hard to just lock in our capital.
Yeah, that's good. Good to know.
We had to move quickly.
Yeah, and
that went away from us, Dan. The oil's dropped now to 74.90. So that market came and went, and we acted quickly and locked in.
Yeah, this is old now.
Yeah, this is old now. This is just last week. So we'll be updating that slide here. But the exciting thing is we locked in numbers way above our budget numbers.
Yeah. Well, you know, the one, this is what people, you know, the market, you know, it flops around it, right? You know, Paul, you and I are old enough, we know, but you know, oil never moved like this. You didn't see these $1, $2, $3 moves in a day. Heck, I remember when a 10-cent move was a big deal.
Right.
It's crazy. And you know, what's going to happen when Trump slaps maximum pressure again on Iran? And I mean, he's going to do something about Venezuela too. So, you know, what's the talk of each day? Today it's something else, and they said he's talking to Saudi Arabia about, well, Saudi Arabia is going to do what's best for Saudi Arabia.
You bet.
And you know, he has a better relationship with them than Biden, obviously, but you know, Saudi Arabia and OPEC Plus wants and can get a stable oil price of $80 Brent. They control the only, you know, available production growth anywhere. I mean, there's nowhere else besides in OPEC Plus, really. And something's going to happen with Russia. There's so much geopolitical noise right now. Nobody knows what to do. Now, as far as the pullback today, people on the call, you need to understand. Okay, there's a lot of paper traders. They're not people that can take physical oil or deliver physical oil. So they have to close out their futures positions in the NYMEX contracts. They have to close those out before they expire because they cannot deliver the oil and they cannot take the oil. And so every time you get near the end of the month, you're going to have some crazy stuff happen. But I think it's the upside. The oil market's much tighter than people think, and it always tightens up in the second quarter because we have about a 2 million barrel a day increase in demand for transportation fuels from first to second quarter. It always happens, and there's not that much excess capacity. So Dennis says institutional investors. Oh yeah, do you show anywhere who your institutional investors are?
Yeah, so we have we're probably about 70% retail, 30% institutional. Our biggest institutional investor is Dimensional, quant fund out of San Antonio, Texas, and San Francisco. So we have a nice smattering. On our bond deal we had a ton of big Canadian institutions come in. CN Pension Fund, Canada Post, Connor Clark. So we have a nice smattering of institutions, but institutional money right now is shying away from Canada due to Trudeau. I think that's going to swing quickly here over the next 3 to 6 months. We have to have an election this year. It's a corrupt government. He's already resigned. There's like 20 scandals waiting to come through the system here. I think it's way worse than Watergate. So we think there's going to be an overwhelming sweep by the Conservatives, similar to Trump. Danielle Smith and Pierre Poilievre are great friends with Trump, and just for everyone on this call. Surge Energy and people in Alberta, we are great trade and business partners with you. And we think this insanity is driven out of Ontario and Quebec, and primarily Quebec. And this will all change, and we'll get a great trading arrangement going. So, yeah, we have a good institutional following, but I think you'll see the institutional money come. Now, we met 2 days ago with a massive US fund that manages 2.2 trillion. I haven't had that kind of meeting in years. So Fidelity manages 5.5 trillion and BlackRock 11 trillion. So Surge is starting to get on we're one of the top oil companies in our peer group in all of Canada, top 2 or 3 companies. So we're starting to see the interest from the south side of the border going. Trump got in, Pierre Poilievre's going to get in. We're going to get sanity back. Foreign investment in Canada was straight off a cliff. It's going to turn. And you saw that chart. If you go to the Peters chart, the 6 or 7 top plays on this call, people are all in Canada.
Yeah, I know.
And that Canada's been a pariah for 9 years under the Liberal government. That's all going to change. Capital comes flowing back into all these top plays, I think, in the next 6 months.
Yeah.
So the market's smart. Guys like Dan and people on this line are looking forward, going, okay, who are the top oil companies in Canada that have dominant position on these plays? Surge Energy's it. We're it. That's why we're going to be the one this year.
Yeah. This world runs on oil, people.
Exactly.
Nothing is going to change that anytime soon. I was at a conference in Dallas a few months ago, and one of the presenters said there's only one form of energy that's actually gone down: whale oil. So
yeah,
there's no energy transition away from fossil fuels. We need energy addition, because even oil, gas, coal, they can't keep up with energy demand the way it's growing, because there's no way to have a higher standard of living around the world, and a bunch of people have low standards of living that want higher standards of living. But anyway, your engineers, do you think your engineers are giving you credit for water flood potential or not?
Yeah, we're getting some great water flood bookings on the Sparky on those horizontal multi-fracs, and then all our mature pools. So year over year, it takes time year over year to get those bookings, but we're getting pretty good reserve bookings on those right now.
Yeah. Yeah, I think another thing people don't understand is these SEC requirements for the companies down here. They only let you show, as in your reserve report, the ones that you're definitely going to develop in the next 5 years. So a lot of these companies hold 10, 12, 15 years of development,
Right.
that would at least be category probable.
So yeah, one thing I would say, Dan, is what's interesting about us is all our water flood is on actual wells that are converted and actually happening.
Yep.
We'd have no future water flood book, like say go to a section that hasn't been converted yet. We haven't booked future flood anywhere, just actual flood.
Yeah. So so you just got you're just going to keep adding.
So you just keep
reserves.
doing. So we keep. Yeah, we're going to do 10, 15 million backfilling with water flood every year. So it just keeps. It's working well.
Does spring breakup impact your well completion schedule?
Good question. Well, a little bit. This year we're with those multi-lats, they're 20-day drills. We're able to keep the multi-lat rig going all through breakup.
Go to that slide. And Murray's got, we're going to be drilling off a pad here all through breakup.
Yeah, like a four well pad, is 80 days. So that gets us, if you just set a rig on a good pad with a good road, we can get through breakup. The Southeast Sask, we always stop. So yeah, we do. Q2 is always a lower capital quarter, but we're still relatively busy for us on a Canadian basis, keeping a rig going there.
Okay. Some people they're just posting statements here. Like, why is the stock such, great story, assets, execution plan. As a long-term investor, it begs the question, why has the stock price been struggling the last couple of years, and what will change the market's perception? It's been struggling because of fear.
Well, just go to our last slide, because I'm just saying to you right now, if you've seen Canada's performance, it's the worst in the G20. Yeah. Where there's 10 of the top analysts in Canada that pick Surge. And I could say we've announced the biggest oil discovery in our company's history. We have an 8.5% dividend yield. And I don't lament our stock price. We trade in a upper half of multiples. It's a, if you want to call it, it's a Trudeau discount where people don't believe our country, and they're right. We have massive deficits, government spending, inflation through the roof, costs through the roof, foreign investment hits the floor. That's all going to turn. So, a shareholder should say, I think, whatever that shareholder said, and then go, what a great buy. Like
Right.
I just want to flip it around. Guys, we're the top performer in the entire country in 2022. I'll come and tell you how good we are when we're 12 bucks again. But at 5.90, load up the truck. You're looking for these opportunities. People on the call. It's still buy low, sell high.
This average,
this
average price of 1070, I can tell you that based on my forecast, that's like 3 times operating cash flow.
Yeah.
No company should be trading below the book, value of the approved reserves. No company should be trading below book value if you got this kind of free cash flow.
We're just gonna keep doing good operational things.
Put out good quarters. Yeah, and then we're gonna. I already told you we're gonna crush the street. All these 10 analysts, we're gonna beat their production and cash flow numbers in Q4. Q1's already looking like we're gonna crush it. We're running way ahead of what we thought. And that again goes to asset quality. But feel free, go buy some smaller company that trades at a higher multiple or something. The bottom line of this, I've had 4 of the most successful oil companies in Canada over the last 30 years. StarTech, Crescent Point, StarPoint, Surge. I've never had a discovery like we have right now at Hope Valley. 8 screamers in a row, 100 to drill. It's a 6, 8, 10,000 barrel field. And we announced it several quarters ago and our stock's down. That's how negative the market is. So keep putting out good quarters, pay a good dividend. We're driving our debt down. Every quarter our debt's been dropping. Even this quarter with these hedges, our debt's flat, probably going to drop a little in our busiest quarter. So it's thrilling. And what Dan's trying to show you and Murray and I is the opportunity. Our stock's going to be 4 times, 4.5 times in a year when the market, as soon as the conservative government comes in. Well, that means it's 9 or 10 bucks. But buying it at 4.90 today, isn't that what this call's all about? Is you guys identifying the top company to buy?
Yeah. Well, I always tell our guys, when they, why does this company, and I said, do you want me to just tell you about companies that I do think have already fully valued? Or do you want me to tell you?
Dan.
You want me to bring to your attention stocks that are super cheap, and you should buy them. And you definitely don't look like you're going bankrupt. So there's no, to me, so many of these Canadian companies are trading as if they're just barely hanging on. And they're doing great. The thing that I see changing, and if you get the government, we finally expose the Green New Deal scam to the whole world. That's not going to replace oil and gas, and it's okay to invest in oil and gas again. I can see then somebody putting together some serious money that comes out and just starts buying up companies to consolidate them.
Yeah, and what's interesting on we are as Canadian or Canada as a country, we're some of the greenest oil and gas regulations. So we aren't flaring. We aren't, like someone asked about the gas time, we aren't allowed to flare. We have we have some of the best emissions per barrel, on all our conventional assets.
Any other questions, Dan?
There's a couple comments here. You've been saying the land value is terrific the last 3 years, which it isn't. You've written off $100 million in worthless land. Well, you're going to have areas that you impair, or you're not going to develop or something. That's just.
So some of the impairments were when we bought things, it was when you booked them when you bought them at 85 oil.
Yeah.
And it's really an oil price drop impairment.
Yeah, so we're going to announce that we're almost at 100% organic replacement on our reserves. And on the non-core assets that we weren't drilling wells on for 4, 5, 6 years, we just said, write those locations off, and then we sold some. So we're just cleaning up our books to make sure there isn't fluff on our books and make it nice and clear and clean.
Yeah, the one question I think is valid to answer is how safe is your dividend if WTI? How long can you maintain your dividend? Let's say
Okay, now good for you. Now that's a damn good question.
yeah.
A year ago, we were $70. With the hedges we put on last week, we've just rerun it all. We're 63.75, 63.75 WTI. And we've done diff hedges that are really excellent. FX hedges that are nice collared, over 60% of our FX exposure this year. And now these hedge positions, we've driven our break even on capital plus the dividend to 63.75 WTI, which is amazing. To drop it even a buck or two is crazy. A year ago, we were right around 70. Now we're 63.75. Good question.
Yeah, I mean,
For a whole year, Dan, for a whole year.
Yeah. Now, are you on your drilling rigs? Are these long-term drilling contracts? Are you committed no matter what the price gone?
No, we just do, you know, program by program commitments. So it's typically six to 12-month commitments. But yeah, like we can stop our rigs, and that's one nice thing about being a bit smaller is just how nimble we can be on drilling different locations for economics and or slowing down. So that's the other thing too. We've been very nimble through time, just through our history of things crater. Like if we went to 50, well, we cut some capital for sure.
Okay. I think that's it. I just want to remind everybody in the call, if you do have any questions, just, go ahead and email them directly to Serge, Paul or Murray. You can email me if you want to talk about my model. I know we have people that are not EPG members on this call. If you're interested in joining Energy Perspectives Group, and my mission and the mission of our group is to find undervalued companies like this and bring them to exposure into, the attention of our members. And then, we provide, I believe are accurate forecast models that are Excel forecast, and you can download them from our website and play with them. I think what we provide is tools that if people want to really do their own due diligence to really look at a company deep down, we've got some tools that we provide to them. So that's a plug for myself. So, but anyway, I ran into you guys, I think at an Enercom conference like 8 or 9 years ago. It was the first time I heard about the company. And I just recently started, like 3 years ago, added it to our small cap growth portfolio, and now the income portfolio, which, as you pointed out on that dividend about investing for dividends, I agree 100%. Especially, as you get up in age like I am, and you're looking to build a portfolio you can live off of, you want dividends and dividends that are sustainable. And so I look a lot, and a lot of my own money is in these companies that are in our high yield income portfolio. All right.
Thanks for your time,
guys. That was great. Thank you.
Great.
Again, to chat again. Really appreciate the time.
Yeah, and if you want to come down here and do a luncheon for us in the fall or something, we're starting to pick up our attendance again. We've moved to a better location, and we're getting 35, 40 people at the luncheons. And we've done, I will tell you, some of our best gains for our members have been on Canadian small caps. Some of the very best, 500-600%.
I'm gonna, on that point, Dan, leave you guys with one point. The gloves are off this year. I believe we're gonna be the top performer in the group, as we were in 2022, and we weren't in 23 or 4. But you just start looking, you can just see our quarters starting to outperform all the 10 analysts, what they're carrying, and we're really excited right now with this new discovery. So thanks for your time, guys.
Yeah, thanks a lot. Now, we did record this. We're going to send out a link to the recording to all of our members here this afternoon, and that usually draws more attention to the stock. Thanks again, and Sabrina, you can end it there.